Welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic and geostrategic analysis on the world's #2 economy. My name is Tony. Let's jump in. Okay, happy Wednesday everybody. This week, Beijing has published more disappointing data, further putting into doubt whether China can see a rebound this year after 3 years of zero COVID, as many analysts had anticipated and all policymakers had hoped. Of course, China will meet its GDP growth target of 5% this year. It would be politically unacceptable not to do so. The question is, will it reach it largely through healthy growth as hoped, through consumption, private investment and exports, or through debt-fueled unhealthy growth, that is public sector infrastructure investment and housing construction, which will happen if Beijing turns once again to the stimulus taps. Let's now move through the official data published by the National Bureau of Statistics yesterday, Tuesday. I appreciate that some viewers simply do not accept official numbers, but at the very least we should be aware of them, and the fact that the official data are disappointing is very telling in of itself. Indeed, even the National Bureau of Statistics itself admitted, quote, "The global environment is still complex and grim, and domestic demand still looks insufficient. Our internal driver for rebound is still not strong." End quote. Retail sales, added value of industrial enterprises, and fixed asset investment all missed expectations. In the month of April, industrial production rose 5.6% from a year earlier, lower than the 10.9% median estimate of economists. Retail sales climbed 18.4%, worse than forecasts for a 21.9% jump by US-based Bloomberg surveyed economists and 21.7% by chief economists polled by China-based Yicai Global. The jump in retail sales was primarily led by a growth in the dining sector, which surged 43.8% in April year-on-year. Now, many of these may sound like impressive increases, but we remember that they are coming off a very low base. This time last year, dozens of entire cities, including Shanghai, were in lockdown. Growth in fixed asset investment slowed to 4.7% in the first 4 months of the year, weaker than the 5.7% forecast by Bloomberg economists. The data also show further declines in property investment. Most analysts agree that Tuesday's official data were not good. Quote, "Today's weaker than expected data show how difficult it is to keep the growth engine running after restarting it." End quote. And others have even more dire warnings. Quote, "As disappointment kicks in, we see a rising risk of downward spiral, resulting in weaker activity data, rising unemployment, persistent disinflation, falling market interest rates, and a weaker currency." End quote. And, quote, "China's activity indicators missed expectations by a wide margin, even with a favorable base. With China now out of the sweet spot of reopening, hope of further sentiment repair could be diminishing in the absence of decisive government actions." End quote. Of course, that decisive government action would largely be yet more debt-fueled stimulus, something most hoped could be avoided this year, and also would mean that unhealthy 2023 growth outcome we touched on at the beginning of the video. We note that these three observations are all from leading Chinese economists in China itself. They cannot be accused of being out-of-touch foreign analysts sitting in London or New York. Julian Evarts-Pritchard of Capital Economics is a little more optimistic, however, writing that China's rebound, quote, "still has some legs left," end quote, pointing to the positive performance during the National Day holiday period at the start of the month. But he warns that this recovery is, quote, "likely to fizzle out during the second half of the year," end quote. But we still need to look at the most concerning data that was published yesterday. Hey guys, if you enjoyed today's episode of China Update, don't forget to hit that like button. It's just me making these episodes every day. It's a lot of work, but your guys' support is a huge source of motivation. Subscribing and sharing is a huge help as well, and for those who can go the extra mile and help me keep the channel financially sustainable, Patreon and Buy Me a Coffee links are in the description below. Thank you so much, everybody, for for the ongoing support. Before we continue with the economy, one brief development on the social front. Normally, social and cultural trends are outside the scope of China Update. However, this development, which has blown up in China, touches on the current political climate in the country, and so it is worth briefly touching on here. Over the weekend, at a comedy show in Beijing, a stand-up comedian, Li Haoshi, who goes by the stage name of House, made a pun which poked fun at one of Xi's exhortations for the People's Liberation Army. Chinese financial media outlet Caixin writes that, quote, "On Saturday, an audience member of that day's stand-up comedy show took to Weibo to post his discomfort with the comedian's comments that his 2 adopted stray dogs chased a squirrel, reminding him of the slogan, 'Forge exemplary conduct, fight to win,' end quote. The post blew up, as has this young man's life. Li has been barred from doing comedy, and he has suffered a large and growing backlash, not just online from netizens, but also across the highest levels of national state media outlets. Xiaoguo Cultural Media, one of China's most influential comedy production companies, who hosted the comedian over the weekend, has also been thrown into controversy. Some international media outlets have described the episode as a cancellation, referring to the phenomenon which has entered the political zeitgeist in the Anglophone West in recent years, whereby a public figure is banned on social media or removed from a high-profile platform, typically due to a controversial stance or past indiscretion, real or perceived. However, this young man in Beijing faces much worse consequences than simply being cancelled. On Monday evening, state-run Beijing Evening News reported that a local law enforcement body in the capital has launched an investigation into the comedy company as well as Li himself, with the state-run People's Daily writing the same day, quote, "It is a mistake to cross this line in mere pursuit of laughter," end quote. Okay, back to the economy. Perhaps the most concerning, albeit not particularly surprising, trend that we saw in the data from yesterday's release is youth unemployment. According to the official data, youth unemployment, which China began recording in 2018, hit 20.4%, surpassing a previous high of 19.9% last summer, and penetrating the psychologically significant 20% threshold for the first time on record. This is up 0.8 percentage points month on month. By contrast, the overall urban unemployment rate fell to 5.2% as the broader labour market tightened. But youth unemployment really does have Beijing concerned. Yesterday, the National Bureau of Statistics emphasised the need to create more jobs for this cohort, with spokesperson Fu Linghui expressing, quote, "More efforts need to be made to stabilize and expand employment for young people," end quote. Analysts are still debating the key causes of the high levels of youth unemployment. One factor is the surging levels of recent graduates, looking for white-collar jobs commensurate with their qualifications. Another factor is that much of the private sector has been decimated in recent years. The headline GDP numbers hide just how in poor shape private corporate balance sheets are versus their public counterparts. And this matters as the private sector traditionally has been the biggest source of new employment, which disproportionately benefits young people. Several key sectors which typically soak up young people and recent graduates have been particularly savaged in recent years too, either by economic crises or regulatory crackdown. These include technology companies, the education sector, and the property market. There is another potential factor too. Duncan Wrigley, chief China economist at Pantheon Macroeconomics, argues that the rising youth unemployment rate is in part due to a skills mismatch in the labour market, observing that since the end of zero COVID, low-end services sector companies have benefited the most, a sector where there are not as many jobs for more educated applicants. Youth unemployment is fast becoming an economic and perhaps even a political crisis. Some analysts remain somewhat optimistic, however. For example, Christopher Bedor, Deputy China Research Director at respected Beijing-based Gavical Dragonomics, argues that economic growth should be enough to eventually bring down this unemployment to less acute levels. However, he admits that this process will be, quote, painfully slow, end quote. The question is, for how long can 1 in 5 young people stomach this pain? Okay, that is today's episode of China Update. Thank you so much everybody for watching. Have a wonderful Wednesday wherever you are, and I will see you all tomorrow.